It's an honor and a pleasure to be here with everyone today. Ron William with MIG Bank based in Switzerland in association for this webinar with FX Street. And today the webinar is Market Timing using Tom DeMark's famous sequential indicator. Should be an interesting and unique presentation, looking at very unique trading techniques developed by Tom DeMark. And just before I start, as is traditional, I just want to give you my contact details. If you want to just follow up with me after the webinar with questions or any follow-up points, my email address is r.william@migbank.com. One more time, r.william@migbank.com. You can access some social media connections from MIG Bank on Facebook. You can also maybe stay in touch with me on Twitter. Type in rwilliam77 to access my Twitter account, or feel free to connect with me on LinkedIn. Just type in Ron William and you'll find me there. And then last but not least, for potential blogs that I might write, you should be able to find it on forexstreet.net, which is part of the FX Street offering. Okay, so that's the start, just for communication. Now, just quick intro for those of you who are maybe new to my webinars. A quick introduction to what I've been focusing on all these years. I've been in the market for almost 15 years now, working with various consultancies, advising institutions, banks, hedge funds, and the like, with trading strategies. My last employment was in a well-known financial media company called Bloomberg, where I also worked as a technical strategist, but I covered their global client base in terms of training their clients on trading techniques, and also being involved in research and development for new ways of looking at the market, use of indicators, and so on. And over these years, my main focus has been market timing, but it's a multi-layered process. I begin each day looking for market cycles. So I'll look back into history for certain time patterns that might repeat into the future, and there are many ways that I do that. Tune in for the next webinar in June, where I'll reveal a little bit about one of my most favored types of analysis, market cycles. Then, of course, patterns and pattern recognition is quite important, part of my toolkit. Japanese candlestick trade setups is something I specialized in for many years, when I was taught to hand draw charts when I started. And so there grew a big appreciation for looking at short-term signals in the market just by identifying patterns such as Japanese candlestick patterns. And of course, the majority of candlestick pattern signals are reversal signals, so this is quite useful for markets which produce a lot of price swings on increased volatility. Japanese candlesticks do offer an edge. Last but not least, when we look into the more advanced and unique set of indicators or market observations that have been developed, certainly Tom DeMark's indicators are seen as the best of the best in terms of looking for market timing opportunities and looking for potential exhaustion points in the market. So this is what the webinar is on, and this is certainly an area that I've been focusing on for several years, partly also because I had the honor to work with Tom DeMark while at Bloomberg, while training our clients on use of his indicators. So this will be a basic presentation of one of his indicators. And in addition to DeMark indicators, I also have my own proprietary studies which I use as an overlay. So these are the three areas: market cycles, pattern recognition, specifically Japanese candlesticks, and more advanced indicators such as DeMark indicators and my own proprietary indicators. All of this is a big focus on market timing. Now, someone's just asking me now, how do I identify market cycles? Is there a commercial tool or own method? I would say it's more my own method, but I will talk about kind of commercial methods that you can maybe identify cycles. It's part of my own proprietary work that I've developed for many years. Just a quick question here. DeMark writes in his books that he did not find cycles good enough. Cycles are as fantastic as they are and valuable as they are. They can be they can create some risk, of course, if you're wrong on the timing by X days or weeks or months. So it's very hard to treat cycles, market cycles, as a scientific way of looking at the market. It's maybe more an art than it is a science, and so for that reason, maybe not as reliable as it can be to some people in the market. Keep in mind that you can use cycles as a roadmap, where you can then start to add your own other more quantitative, systematic tools. But I do start with my cycle analysis, which, as I just said, is more of an art form than it is a science. And so for some people, it's not as reliable or as or something that maybe you can backtest and quantify certain results from. But still, I do believe it's valuable, and valuable for one reason: market timing, and that has been my focus over the last few years. Now, before we begin, I always like to ask all of you, the world at large, in this global webinar, where are each of you dialing in from, signing up from? Which country in the world are you from? And is this your first time attending the webinars, or are you a regular attendee of my webinars? So just if you can just let me know, everyone could just quickly contribute. And please, if the FX Street team could just quickly screen capture this, because this is always a very interesting part of the webinar, where we see where all the audience are from. So we have the United Kingdom, Kuwait, Poland, Portugal, third time, Africa, Switzerland, Zurich, France for the first time, Australia, London, Birmingham University, New York, Mallorca, Spain, Poland, regular from US, Texas, and second time from Switzerland, Japan, we're in the UK at the moment, so the time zone works for you at the moment. That's good to hear. Anyone else? So we have quite a nice kind of rich contribution of global audience here attending this webinar from MIG Bank in association with FX Street. And one of the points I'd like to highlight here is the sheer global contribution that each of you bring to the table really adds a lot of value to the webinar, because we will go through different market views or educational training such as the one that I'm about to give now, but it really doesn't matter where in the world you are, because capital flows will mean different things to different people. And so it's interesting to find out your perspective in terms of how my market outlook or trading techniques will influence you wherever in the world you are. So we really do kind of enrich the conversation by coming from so many different countries. And I really encourage more global presence in these webinars here. Okay, and we have one person from Melbourne then. So welcome to everyone. So where in the world are you from? These are becoming very much global webinars, monthly webinars that I give here here at MIG Bank in association with FX Street, and have done for almost 2 years now. Okay, so this is what we're going to be looking at. 3 parts. Part 1, focusing on Tom DeMark, a modern market wizard, truly a genius in the financial market field in terms of the research he's developed and the results that he's acquired, successful results. In part 1, we talk about Tom DeMark, and we also talk about trends and market timing. So little interesting points that I will make there. Part 2 focuses on the one indicator that we'll be talking that I'll be presenting about, and that is the TD Sequential model. Keep in mind that Tom DeMark has many other valuable indicators, over 40, a suite of over 40 indicators, and this is just one of them. This is one of the most popular indicators that he's developed, and this is over 40 years worth of research in development of this indicator and other indicators that you might come across. So in part 2, we talk about the most famous and successful indicator, TD Sequential. We discuss what are the key stages. You should be accustomed to these stages, TD setup and TD countdown. So these are specific trademark stages that Tom DeMark describes as part of the model. And then the signals are numerical signals 9 and 13. So these are key signals that identify turning points in the market, exhaustion points in the market. Part 3, I had hoped to give a lot more practical real-time examples, but it might not be possible due to technical issues today. So most of my examples are screenshots. So we'll keep with the screenshots for now, and maybe in the future when I do another follow-up to this DeMark webinar, there'll be a lot more real-time examples which I can show you across different markets and different time frames. So part 1, DeMark, the man, a modern wizard, a little bit about trends and market timing. Part 2, we talk about the most famous indicator that Tom DeMark developed, TD Sequential model, the key stages, how to successfully trade these signals 9 and 13. And part 3 will be probably a little few moments for those of you that have questions. Okay, so just a quick disclaimer that I traditionally show. No information here constitutes a recommendation to buy or sell. The information is only for educational purposes, and please keep that in mind. I'm just legally obliged just to quickly share that with you. Now, this is Tom DeMark. So we have start off with a picture from many years ago of Tom DeMark, truly a market wizard of modern times in the financial market. Now, Tom DeMark is the creator of DeMark Indicators and CEO of Market Studies, his own independent research company. All his indicators are trademarked and copyright protected. Over 40 years of research, proprietary research, the DeMark studies are known internationally for 2 key points: their objectiveness and mechanically driven approach. And this is probably attractive to, I think, most of you here in the webinar, and certainly myself when I first got introduced to these indicators. It is a great way to have a objective view to the market. Of course, there is still an element of your own discretionary rules and guidelines, but he has developed a very successful, systematic, and objective tool in which we can apply our own judgment to. Now, this judgment is designed to anticipate potential price activity. So this is almost predicting movement in the future, which of course is an added edge in the market. And the predicted price activity tends to be market reversals, or otherwise termed as price exhaustion. So that's basically what we're looking for whenever we look at DeMark indicators, especially sequential indicator, or the sister of sequential indicator, the combo indicator, which is a more aggressive version of the sequential indicator. So that's what we're looking at. We're looking at an indicator that helps, objectively, mechanically helps us identify exhaustion points in the market and potential reversal points in the market. Now, question I ask everyone is, why might that be relevant? If a market is very volatile, why might it be relevant to have an indicator that identifies exhaustion or reversal points? Anyone want to tell me? What is it about the volatile markets that is what is the characteristic of volatile markets? Can anyone tell me? Market turns. So volatile markets tend to exhibit a lot of turns, price swings, points to get out and back in for range trading. Absolutely. So big pullbacks. So good responses from everyone. Volatile markets. In a volatile market, market timing is key. It's vital. And market timing can mean trying to get in and out around market turns, reversals, big pullbacks, or when you're trading the range and there are various price swings, it is also good to have that edge in the market to know when that turn may take place in the market. Now, there was a question, I think, from one of the attendees, is how do you subscribe to DeMark indicators, or what is the cost? A lot of DeMark's indicators are mainly on institutional platforms such as Bloomberg, CQG, and Reuters, and maybe a few others, but they're the three very well-known platforms. If you do see DeMark indicators on any other platform, I would check with Tom DeMark's team at Market Studies. If you just type in marketstudies.com on the web, you can find their details there. Because what is very important is that you're using the indicator that is originally designed, trademarked, and copyright protected by DeMark. Reason behind that is, of course, you want to make sure you're using the very indicator that Tom DeMark developed, and not a copy of that indicator, which of course wouldn't help your performance and wouldn't be legal as well. So you do have to subscribe to DeMark's indicators, and you would need to get in touch with Market Studies for that. Okay, so I hope that helps. So someone's asking, you may be able to find it on trading platforms. Yeah, good point here is you don't know their quality. So if you're using something out there, make sure that the results are matchable with Tom DeMark's indicators, and that's all I can say on the matter. Okay. Okay, so for those of you who just want to learn about Tom DeMark's indicators, maybe you're not using it at the moment, but you would like to learn a bit more about the philosophy for your trading techniques. Even if you don't have DeMark's indicators at the moment, I really just recommend just learning about his philosophy, because he truly is a market wizard, market guru of his time, and there is a lot that you can learn from him. And of course, if you are able to use his indicators on some of the platforms I mentioned, then even better. But in the meantime, these are the books that I recommend. Some of the more older books written by Tom DeMark himself are The New Science of Technical Analysis, and then the second book, DeMark on Day Trading Options, which is on the options market, but it does have a lot of information on his indicators in it as well. And one of the most popular books on DeMark indicators, and that is DeMark Indicators by Jason Pearl. Jason Pearl is a technical strategist at UBS, used to be the global technical strategist at UBS, a great guy, very smart guy, who's seen as maybe one of the leading experts in using DeMark indicators. He has done for many, many years, especially in the FX market. So these are the books that I would recommend, and out of all of them, I would definitely recommend DeMark Indicators by Jason Pearl, and that's published by Bloomberg. Someone's just asking, does DeMark still work at Bloomberg? Tom DeMark has a relationship with Bloomberg and other vendors, and yes, he still has an active relationship with Bloomberg, as well as other vendors. Okay, so let's start. Now I'm starting with a picture. A picture speaks 1,000 words, and I start with this beautiful picture of a sunrise to ask the question, or to make the point that in life, as in markets, we take a lot of things for advantage, such as the sun rising every day, every morning, wherever in the world you are from. Now, every day, every morning, we know that the sun will rise, but in the market, different to maybe life, there are exceptions to the rule. And these exceptions to the rule are either opportunities for us to make money or risks where we can lose money. So it's very important to keep in mind that there are many similarities, many points that we do take for advantage, as we do in life and in the market. But keep in mind that in the market there are many exceptions to the rule. And one of the big exceptions are trends, and that trends actually last forever. Now, of course, we know that is not the case. Trends do not last forever, and the efficient market hypothesis is probably not the best theoretical model for describing the reality of what happens in the market, that the market is random. we know that the market is not random, and there is a pattern to market activity, and that pattern is best described statistically by this probability distribution here, which basically shows the most important part is the long tails of this probability distribution, basically showing the amount of volatility that might take place in the market. So these are what we call bat tails. The longer the tails, the longer the ends are within the yellow box, the more volatility or the more deviations from the mean we experience in the market. And it's during these highly volatile periods that we get trends, uptrends, downtrends, or sometimes just very erratic movements in the market, very volatile movements in the market, big shocks as well. But this is very much the market that we live in. And so this diagram, I hope, helps explain the exception to the rules that we experience in the markets in terms of trends, how they develop, but also how they end and reverse. Now, just to explain another point about trend, the previous example I was just talking about trends from a theoretical statistical standpoint and making the point that trends undergo a lot of volatility and fat tails and event shocks and so on. But price momentum itself is a measure of another variable, and this variable is very important to keep in mind whenever we trade. That variable is speed. Market trends or market price movement, momentum, is a measure of speed, rate of change. And if you just look at the pictures that I've just put on the right-hand corner, you can see there a beautiful sports car racing ahead on the highway. And what I always like to say to people that I train across the world over the years is imagine yourself in your favorite sports car, Lamborghini, Porsche, or Ferrari, and you're driving fast, you're enjoying life, you're enjoying a new car, and you're driving down that highway. You'll be driving very fast, enjoying the speed, and for some reason that road might turn quite dramatically, and when it does, you may need to slow down the speed. Now, you haven't turned the car. You haven't turned the car around, you haven't done a U-turn, but you start to slow the speed. And so from an onlooker looking at the car from behind, all you see is the car slow down. You don't see a change in direction, you see a change of speed. And so this is quite a subtle point sometimes that to the human eye it's very difficult to notice. And this is the key point I want to make here, that speed, price momentum is an important element in trying to identify this, the rate of change, potential exhaustion, and potential reversal. Remember, the trend is your friend until signs of reversal emerge, just as the market mantra that I just highlighted in the top-hand corner. So the best way I can explain this is if you can just see here in the trend, the market accumulates and then starts to accelerate, and then as the trend matures, it then starts to decelerate. So acceleration, deceleration are the very kind of measures of rate of change, rate of price momentum, or think of the sports cars speeding up and down that we experience. So the question is, how can we best measure price momentum or market speed so that we can anticipate exhaustion or potential reversal points? And of course, one of the answers or the central answers to this is indicators such as Tom DeMark's sequential indicator, which I think is one of the best indicators for measuring market exhaustion and potential price reversals. Is that clear to everyone, just from a theoretical perspective, where I'm going so far with this presentation? Is that okay with everyone? Just conceptually, the idea of market trends, don't take it for advantage. Keep in mind that there are exceptions to the rule. Trends do become tied and they do reverse. And one of the best ways to know when a trend is about to reverse is to look at the speed. And this can be quite a subtle or dramatic detail in our analysis. Now, as you notice the speed changes in a market, just as you would do in that sports car that you're driving, you need to kind of play a counterintuitive game with your mind as a trader or investor. And that is to think that buying into weakness might be a good idea, or selling into strength might be another good idea. Now, if I may ask each of you here in this room, how many people agree with this statement? How many people like to buy into weakness and sell into strength? Because to understand and use this type of methodology, keep in mind it is a counter-trend, counter-cyclical methodology. So you really need to kind of be in sync with this idea of buying into weakness and selling into strength. How many people agree with this? How many people disagree with this? If we just do a quick survey, and please FX Street team, if you could just quickly do a snapshot of the answers. It'd be quite interesting just to see here with the 50 plus attendees that we have from around the world, how many of these traders and investors like to buy into weakness and sell into strength. So we have Spin Doctor saying like a lot, Mike saying absolutely, Toshi saying weakness and strength sound vague. I agree. But if you can just think of counter trend trade opportunities, it's a matter of timing, totally for low risk entries, hard to wrap head around. I do not think it's a bad idea. It's a good idea so long as you use a small stop. I agree. You need to have a very hard and fast exit strategy with these types of trade tactics. And then a few other people agree. So I think it's a general consensus opinion amongst all the attendees from around the world here attending this webinar on DeMark indicators, TD Sequential, that the trade tactic of buying into weakness and selling into strength is okay with most of you here in the forum. Now, one of the good points that you did make is, I think one of the attendees made, is that if you were to apply such a strategy, this counter-trend, counter-cyclical strategy, you would really need to have quite a strong and fast exit strategy, just in case you were wrong for whatever reason. And of course, strategies can be wrong, and when you are wrong, you probably want to get out as quickly as possible. Now, most people say that buying into weakness is similar to catching a falling knife, and so most trend followers aren't too keen on this type of trade tactic. I would say for trend followers or for counter trend individuals, this is still a good opportunity. If you're a trend follower, you can at least know when that trend or that momentum trade that you are making money in may start to turn against you. And if you like to look at the turning points, then you can just use it as a market timing indicator and try and actually buy into weakness or sell into strength. So I would say if you are a trend follower or a market timer looking for tops and bottoms, this is still a good strategy that you can apply. Traditionally, people that use DeMark's indicators tend to be market timers, so people who are looking to buy into strength or sell into weakness. But from my experience, you can use both. You can be a trend follower and a market timer looking for tops and bottoms with DeMark's indicators. Is that clear to everyone? Yeah. So I'm saying get your head around this counterintuitive buy into weakness, sell into strength. But if you're a die-hard classical trend follower, you can still use this to at least know when that market becomes overbought or oversold in classic terminology. Okay. Now, one of the key research points that Tom DeMark's company, Market Studies, developed after 40 years of research. During that 40 years worth of research, his team and Tom DeMark discovered that the reason why markets top and bottom, and it goes against popular belief. And what they basically said is written on the screen here. Markets top not because of smart sellers, but because the last buyer has bought. So for example, when the gold market sold off just before it hit that, just beneath the $2,000 psychological level, most people in the market were saying central banks around the world might be selling gold, or big hedge funds maybe changing their capital flow positions, and so on and so forth. People were looking for the smart seller, the big cat or the big fish in the market that is selling in the market and thereby creating that top, the market maker, the central bank, or maybe the hedge fund scapegoat. But that is not the case. Markets top not because of these supposed smart sellers, but because the last buyer has bought. And this is really critical. Can anyone tell me what that means? What does it mean when we say the last buyer has bought? This is really important. Can anyone tell me the last buyer has bought? So everyone in the market has been buying, and because the last buyer has bought, there are no many buyers left, no more demand, as Greg just said. Well done. And Fernanda just also said this creates price exhaustion, no more buyers, so the market should reverse. That's something that Robert just said. So absolutely. And so for that reason, another contributor just said sellers are returning. So it's this whole idea of demand and supply, buyers and sellers, this big battle between these two dynamics of in the market. And in the end, because of this, it creates a vacuum. And that price vacuum by itself creates exhaustion in terms of the last buyer having bought. So there are too many buyers in the market, and so there aren't any more buyers really to sustain that uptrend. That creates a price vacuum in which sellers start to have more effect, and then this can obviously lead to a reversal. Also, think of the buyers in the market maybe being leveraged in the market, and once you do get that sharp reversal, then a lot of margin calls kick in if we're talking about the stock market, for example, and that then accelerates the reversal. So a lot of times it is a technical process that is taking place in the market, and in the case of a market top, it's not because of smart sellers, not because of this big central bank or hedge fund or some kind of market maker. It is because the last buyer has bought, and as each of you have just said here successfully in the forum, this means that there's no more demand. Last buyer has bought. The market should reverse because of this exhaustion, and we get the reversal. And the opposite is true. A market bottoms not because of smart buyers, but because the last seller has sold. So that's the exact opposite for a downtrend. Think of the US dollar. Everyone was so bearish on the US dollar several months ago, just from the economic and technical backdrop. But in the end, US dollar has seen a very strong upside reversal or long-term cycle reversal. And a lot of the times people were saying, why is the US dollar reversed? And again, the US dollar example, because many people in the market were so bearish, there were so many sellers, the last seller had sold, and for that reason, the market was due an oversold bounce or a reversal thereafter. Okay, so just keep this in mind. Markets top not because of smart sellers, but because the last buyer has bought, and markets bottom not because of smart buyers, but because the last seller has sold. Okay, so here's an example that I kind of put together. This is a real example, but I've just kind of annotated this. The S&P 500 reversing in the last few weeks from what has been a very strong uptrend. Certainly the US equity markets have been the strongest in the Western equity world. And a few weeks ago, we did get one of the last DeMark exhaustion signals, and that is exhibited by the red number 13 there, which appeared just at the peak, the actual major peak, most recent major peak on the S&P 500. Now we did have an exhaustion signal before then, where the market kind of bypassed and continued to move higher. But the very last signal that I'm showing you there, just as we developed that that kind of minor triple top pattern, the market did reverse sharply and is currently within that rollover mode. Can everyone just see there? I'm not sure. Can anyone see the mouse on the chart? I'm just wondering if I can just quickly draw something here. So the signal basically appeared around this point here. Can everyone see that on the chart? Yes? Can you all see the annotation that the circle that I just highlighted on the chart? Great, okay. So that's when the signal appeared. We also had a signal appear around around this area here. The market continued higher because it was still strong, just like you get an overbought signal. The market remains overbought and it continues to move higher. And then finally, this signal here really was quite strong, quite potent, and we had the triple top 1, 2, 3. After then we got the reversal. Now, one point I'll make here. So this is a key signal to keep in mind. One of the ways that you can use DeMark's indicators is, of course, in addition to all your classic analysis. So your classic analysis may be telling you that there's a classic head and shoulders pattern here, as Wojciech just said. And so that would then have given you a lead signal to this pattern taking place. And as a target, of course, you would want, we've already broken below the neckline, but you would maybe want to break below these swing lows. But furthermore, this 1250 level is quite important because it's very near 1250, 1248. It's very close to the 200-day moving average and the 50% retracement. So it would be quite an important level for the market to be magnetized to on the downside. So I'm giving you kind of a very important DeMark signal, sequential DeMark signal that appeared in the market just a few weeks ago on the S&P 500. It was very important in actually telling you not only that the S&P was about to reverse because it was so exhausted, but also the rest of the US equity market, European market, and general risk appetite portfolios, risk-centric portfolios, which were starting to unwind during this seasonally weak environment. Remember the turn of phrase, sell in May and go away, where volatility tends to increase. So this was not just the S&P 500, this was a lot more than that. This was signaling the domino effect in the market. And good question. Which time frame is this on? This is on the daily chart. Keep in mind that you can use DeMark indicators across all time frames, intraday time frames, from minute charts to 5-minute charts to 15-minute charts, all the way up to daily, weekly, monthly charts as well. So this is a daily chart. One of the best ways to use DeMark indicators, as you would do with any other type of analysis, is to use it across multiple time frames to increase the probability of that signal taking place. Okay, so in this example, I just showed you the most important signal on the U.S. equity market, the S&P 500, which was triggered a few weeks ago, the DeMark TD Sequential indicator, signaling exhaustion with the red 13, which is the signal itself, just at the market top. And for classic market observers, you can see that it also then developed into a pattern, a reversal pattern, otherwise known as a head and shoulders reversal pattern, which we have punched below. And one of my key targets on the downside is around 1250, which is roughly where the 200-day moving average is, and the 50% retracement zone, which basically would symbolize where the market would have lost half of what it made since the bull rally began in September of last year. Is everyone okay with that? S&P 500? Yeah? If I just get a few yeses just so I can move on to the methodology of how DeMark's indicators are actually developed. Okay, great. So that's part one. We've spoken about Tom DeMark, the modern market wizard, and just a little bit about how you can access indicators and the 40 years worth of development research that was put into his indicators. And I spent quite a bit of time talking about the true nature of trends, understanding the concept of speed, the subtleties of what speed can tell us about market exhaustion and market reversals. And then we've just kind of spoke throughout that about the idea of market timing being everything, especially in volatile markets, because volatile markets tend to produce a lot of price swings. And so any market timing indicator or analysis does give you an edge, especially in volatile markets, in terms of entering a trade opportunity and also, keep in mind, exiting a trading opportunity. Okay, so part two, we're actually going to talk about the TD Sequential model. What are the key stages? Remember, I said the key stages are TD setup and TD countdown. There are only two stages that you need to remember within the sequential model. And then I'm just going to mention just a few points as to basic points as to how to successfully trade the 9 and 13 signals. Keep in mind this is just a basic seminar. I just want to familiarize everyone to the TD Sequential indicator developed by Tom DeMark. And in future webinars, then I can do intermediate and advanced sessions. But for now, I just want to keep it light. I just want to keep it simple and focused. Now there's a question from Mike Chandler. As frequently as you see range-bound trading, have you found the value of TD range, particularly long-term frames? I would say yes, very much. And I'll quickly show you how you can use TD Sequential in range-bound market. One example I will show you is euro-dollar. Another question from an attendee, Boyke. By the way, 15-minute remain as someone 15-minute remains as someone else. Yeah, okay. So we're running out of time, so I'll just quickly speed along. Okay, so this is a theoretical kind of illustration of the TD sequential model. It can take many different forms, but this is just my very simplistic theoretical illustration of how the TD sequential model it develops in the market. And it is quite dynamic. Now, remember I said it's a two-stage process, TD setup, TD countdown, and these stages are color-coded. TD setup is color-coded in green, TD countdown is color-coded in red. But to actually initiate both of these stages, you must have what we call a TD price flip. And that's the initiation stage of this sequential model. Is everyone okay with that? So it's a two-stage process, TD setup, TD countdown. The first stage, TD setup, is color-coded in green. The second stage, TD countdown, is color-coded in red. But to actually trigger or activate this process, we must have a price flip. Now, in front of each of these stages, the letters TD, of course, are, as you may have guessed, after the creator of these indicators, Tom DeMark. So everything is patented TD. So TD price flip, the initiation stage, TD setup, stage 1, and TD countdown, the last stage, the second and the last stage. Now, the numbers are critical. First stage, the TD setup, you will know that stage has been completed when you get the number red appear. And the last stage, the TD countdown, you will know when that stage and the grand signal itself, the final signal itself of the entire sequential process, you'll know when that signal has been activated by the number 13. Now, a lot of people ask why 9, why 13? Now, this is down to DeMark's research that he had done over the last 40 years. And when he was developing the sequential model, he originally started using Fibonacci numbers because he believed in the mathematical and natural properties of Fibonacci numbers. But when backtesting these numbers in his own kind of manual empirical research, he preferred to use 9 as opposed to 8 from the Fibonacci sequence. And so we have 9 as a completion of the setup sequence, and 13 as the completion of the countdown sequence, and 13 is, of course, the Fibonacci number. But try not to focus too much on the numbers, because essentially this model is, in my opinion, so good and robust in what it does, in terms of how it's calculated, in terms of how it measures market exhaustion, that the numbers aren't as important as you might think they are. Of course, they are the successful back-tested results of Tom DeMark's work, but try not to focus too much on the numbers, because it is actually the methodology behind the numbers more than the numbers themselves. Okay? Keep that in mind. It's the methodology behind the process rather than the numbers themselves. Okay, so is everyone okay with this TD sequential theoretical illustration that I've just gone through? Can I just get a few yeses? Because it does get a little bit more complex from here, and I just want to make sure I'm taking each of you step by step. Everyone okay? Any questions? I'll pause for a question or two. Okay, everyone seems to be okay. One added point I'm going to make is that the TD setup and TD countdown is, what we're doing is comparing a price close to a previous price close. So in each of these stages, what is the algorithm that DeMark developed is actually focusing on closing prices initially. And in the setup process, it's looking at consecutive price closes. In the countdown stage, we are looking at non-consecutive price closes. Now, just keep that in mind for now. We're looking at price closes, and in the TD setup, we're looking at consecutive price closes. So the algorithm must take place day 1, 2, 3, 4, 5, 6, 7, 8, 9. And the TD countdown stage, it's non-consecutive, so it's more of a looser calculation in TD countdown in terms of the comparisons of price closes. Okay. Now, the TD price flip is the initiation process. The TD setup is quite an aggressive process. It's where you get the real directional move, and the TD countdown is more the exhaustion stage. So just keep in mind that from a psychological or market structure perspective, TD setup is the market direction. It's quite an aggressive algorithm, and the TD countdown is quite is more of a weaker criteria in the sense that it's not as aggressive as TD setup in some ways. And so for that reason, it tends to allow the market to really exhaust, for that trend to really run out of price momentum before we get that red 13 appear on the chart. Okay, I'm going to move on now. Hopefully that should be clear to everyone. And now we're going to the more kind of advanced area. Now, TD setup, as I mentioned, compares price close to price close. And we can see here TD setup, which is the first stage. We need a close to be greater than the close 4 bars ago. So four bars in history. So I've just highlighted the close in red, and you can see there that this close here, if I can just highlight it for you, this close here is greater than the close 4 bars previous. And so if I just show you here, this is bar 1, this is bar 2, bar 3, and bar 4. So for that reason, this price bar here, because the close is greater than the close 4 bars in history, then we get the activation or the initiation of the setup process. Was everyone okay on that? So the close must be greater than the close 4 bars in history, 4 bars before, and once we get that 4th bar close activation, then I mean, this is basically what we call a price flip. Then we can get the initial TD setup stage activated. Someone's saying greater as in lower close than 4 bars. It can be either greater as in higher or lower, but in this example it's lower. So yes, it can be lower or higher. That's a good question, Toshi. So it can be lower or higher. But the word greater is used because it's ambivalent to direction. It can be a bull signal or bear signal. But in this example, it's a bearish. Sorry, it's not bearish, but in this signal, it's highlighting the down phase. It's measuring the downtrend, which may then reverse higher. Okay. Anyway, I don't want to get stuck in the semantics here because it will be a lot clearer once I show you the entire process on one diagram. So to initiate the price flip, you need a close to be greater than the close 4 bars ago. So you can see there, this close is greater than the close 4 bars ago in history. And as you quite rightly said, it can be a close above or below, higher or lower than the bar 4 bars previous in history. But in this example, it's beneath 4 bars previous in history. Okay, so that's the TD price flip. Now, once we've had the price flip, we can then activate the setup. Now, the setup is, remember that first stage where we get a numerical count from 1 to 9, and that count is color-coded in green. Now, for the TD setup process, we need 9 closes, in this example, less than the respective closes 4 bars ago. So once we've had the activation bar, remember the activation bar was here. Once we've had that, the next bar then is then bar 1 of a 9 bar sequence or setup sequence, and that sequence needs to have a close less than the respective close 4 bars ago. So again, we can just count 4 bars previous, 1, 2, 3, 4, and you can see this close is lower than this close here. Than 4 bars ago, than this close here. And so here we can see basically the same model developing out into the future, and we have day 1 or the first minute or the first week or month of this process taking place in the TD setup stage. Is everyone okay with that? So stage 1 is 9 closes less than their respective close 4 bars ago. Now the key point here is it's consecutive. So this is bar 1, but then bar 2, 3, 4, 5, 6, 7, 8, 9 all consecutively have to equate to the same algorithm. So we have to have 9 consecutive closes less than their respective closes 4 bars ago. If that doesn't happen, then this indicator then just continues to look for that criteria to be fulfilled. So this criteria must be filled in order for the stage to be triggered, and then in order for the next stage to complete. Is everyone clear on that? Yeah, so Fernando's just saying here, each bar is compared with a bar 4 bars back. So if you think of a -4 back period, in history. Any questions at this point? So this is the setup stage. The previous stage I spoke about was the price flip, which led to the setup stage, and now we're moving from the setup stage to the countdown stage. Now Robert's just saying, adding and removing equal signs makes the difference on a setup countdown for completion. Even DeMark changed it from his book. Mr. Pearl, I think, as well. Which settings you use, and did you perform known tests? Okay, I'll answer that probably through an email later on. Okay, so that's the setup stage. Now I'm going to show you the setup stage in a more realistic picture here, and we can see here the initial price flip in this stage here, where the close is greater than the close 4 bars ago. This is then followed by 9 closes less than their respective closes 4 bars back in history, and we can see that happening on a consecutive, remember I said, consecutive time frame. So every single day, week, or month, or minute, this criteria must be fulfilled. So we can see here bar 1, 2, 3, 4, 5, 6, 7, 8, 9. Each of them consecutively have closed lower than 4 bars previous in history. And so remember I said the TD setup stage was quite an aggressive criteria. It's quite aggressive because the algorithm is looking for a consecutive succession of closes lower than 4 bars previous. So because it's consecutive, it's quite aggressive. And the reason why it is aggressive is because it's looking for that sharp directional move in the market. It's looking to filter out that sharp directional move in the market, which then leads to the trend exhaustion stage in TD countdown. Is that okay with everyone? So I've explained, just very general, in a general overview, high-level perspective, the algorithm. This is just part of the algorithm. Of course, the algorithm is proprietary, and so a lot of it is trademarked and copyright protected by Tom DeMark. So if you want to learn more or ask more, go to Market Studies and find out from their team or through the educational books that I mentioned to you. But from a very overview perspective, I'm just letting you know just roughly how the algorithm, generally speaking, is explained. Now I'm just going to quickly move on to the next slide now. Here's an example of the setup stage, the number 9, the green 9, within a range-bound market. So here we have, I think someone asked me before, how can you use TD Sequential in a market which is range-bound? Eurodollar, of course, has been range-bound for over 4 months, the first 4 months of this year, and it's been range-bound, with very low volatility around that psychological 130 level, which we have just broken beneath. Now, during that time, we did see 9 signals
So the setup signals activated in the market. Now, this wasn't telling you that the market was going to reverse, but it does suggest that there might be a minor pullback in the market. So interestingly, if you were just, trading the price swings on euro-dollar over the last few months on the daily chart, the TD Sequential setup, just the number 9 itself, without even looking at the countdown stage, was useful in picking out some of the intermediate price swings on euro-dollar. And of course, just very recently, we've had the key break beneath psychological level at 130. My view is that we do get a push much lower into the 2012 low in January, which is around 126.24. Keep in mind that from a macro perspective, this is down to the political storm which is taking place in France and Greece with the elections, which is negative for Europe, and also we're seeing euro weakness because of the relative effect of US dollar strength as safe haven flows increase due to the rise in volatility that we're seeing and general deleveraging that we're seeing in the market. So euro-dollar looking bearish for the lows in January, 126.24, but during that range-bound period, which is just broken beneath 130, we have seen the TD Sequential setup signal, that green number 9, appearing on the chart. Is that clear to everyone? So the number 9s for range-bound market, when you can maybe look for intermediate price swings. Okay, great. Okay, now TD Countdown is the last and final stage. 13 closes. What we're looking here is we're looking for 13 closes less than or equal to the low 2 bars previous. So remember, the setup stage was looking at 9 consecutive closes compared to the close 4 bars previous. This is looking at 13 non-consecutive closes, and it must be less than or equal to the low 2 bars ago. So here I'm just showing you that example. So here you can see bar 1 lower than the close being lower than the second bar or equal to. Now that has to happen on 3 bars. That has to happen for 13 bars, and they don't have to be consecutive, they are non-consecutive. Okay, I'm just speeding along here just so we can just wrap up. But this is the countdown stage. It's 13 sessions, minutes, days, or bars, and they're non-consecutive, and so there's a filter of 2 bars where we're looking at the low, the current close compared to the previous low, which needs to be equal to or greater than. Okay. This is the countdown phase in the final stage. Just showing you there, 13 closes less than or equal to. So I just quickly show it to you here on the slide, which is more realistic. And then I'm just quickly showing you a real-time example of this on dollar yen, where we can see the 13s appearing at one of the major lows and at one of the major highs, which triggered the major pullback. As these 13s are calculated, so the final signal is created, we get a risk level. This is a volatility-based level in the market, which the indicator derives, telling you that beyond this point, based on a specific criteria, the signal is neutralized. So you can see here that on dollar yen, when dollar yen pushed 10% up in just 7 weeks, the market was suggesting a reversal. DeMark's sequential indicator suggesting a reversal, but it hit above the risk level, didn't fulfill the criteria for neutralizing the signal. So this was still an active signal, and then we had the major pullback down. So this is a good idea. Here we had the 13 signal appearing at the bottom, and the risk line was not touched. So that would have been a more focused signal to take on. Here we have the signal, the market was quite fast and furious. It did move above the risk level, but it was only temporary. It didn't fulfill the criteria for neutralizing the signal, and we got the major pullback as the market became very overbought. Okay, so that's almost the end of the presentation. I'm just going to end on two examples. I've already spoken to you about how to manage your risk profile just very quickly on the TD risk. One point I'll say about TD risk is it is a rough guideline in the market. It is not a stop level. It is a line in the sand at which you should look for the signal to potentially neutralize, and it just tells you that the market's about to turn. And the final charts I'm going to show you are just here now. So one of the important charts I'm going to show you is gold downside risk as it approaches that target at 1522, and it shows you here a DeMark exhaustion signal appearing at the one of the peaks in February, one of the key peaks of February, just beneath 1600, 1610, which is key level. That led to a $103 drop in just one day. So that DeMark exhaustion signal based on sequential on a daily chart was quite key. I can show you many other signals on intraday, daily, weekly, and monthly charts, but I'm just keeping it on these charts for now. That led to the $103 drop in just one day and suggested to you that psychologically that the gold market was still due to further downside, and that's partly down to gold acting as a risk trade as opposed to a safe haven trade. Now it's exhibiting two personalities, and it's part of this broad deleveraging that we're seeing in the market during this high volatility seasonal stage in the market. Very last one is on dollar yen, and we can see here the dollar yen cycle awaken. Remember I told you the 10% rise in only 7 weeks. We had the DeMark exhaustion signal there appear at the start and at the end of that move. I'm now going to end and just let you know if any questions, please just email me on the email address r.william@migbank.com. If you would like any of the charts or as well, I can send you some. And if you would like to subscribe to some of our research here at MIG Bank, I cover FX predominantly, but also other asset classes. We can sign up for a 1-month free trial. Also, you can contact me on Twitter. Remember, rwilliam77, or reach out to me on my LinkedIn, Ron William. Feel free to connect with me, and my blogs can be found on forexstreet.net. Very last thing I want to promote to each of you is the next webinar on the 7th of June at 1500 GMT, the cyclical nature of markets, where I will do a very basic presentation of cycles and how you can maybe understand the nature of cycles and how they apply to markets, but also I'll try and mention just a few basic ways you can measure cycles. Okay, and one last to mention that I will be in the FX Street's annual ITC event in June in Barcelona. So FX Street have just advertised that there. It's been an honor and a pleasure sharing this webinar with each of you here. I hope you enjoyed it. Enlightenment to realized knowledge. And please, any questions that you have, feel free to email me on r.william@migbank.com. Thank you, FX Street, for giving me this forum. And thank you for all of you here attending from around the world. Ron William, technical strategist from MIG Bank based in Switzerland, signing off. See you on the 7th of June, the cyclical nature of markets. Thank you very much. Bye-bye.